Hello, Facebook family and friends. How are you today? This is Moss from Investor Partner Group coming in live today. Very interesting discussion that we are going to have today. Happy Friday for those who are joining in for live today. We have up to 5 o'clock for this meeting, and the discussion for today is how to generate cash flows from existing properties. I'm going to give probably another sort of 10-15 seconds for other people to join in. I have my own computer or my own phone going here on the right hand side to see as to what the comments are and what people are saying. Um, Please do jump into the comments and say hello. Where are you calling from, or where are you joining in from? What are you trying to achieve out of this session? And if there is any questions in specific that you are looking for from this session, that would be great. Just put it in the comments below. Okay. Perfect. I'm not seeing any comments coming in right now. Hi, Yuli. Hi, Rizwan. Hi, Michael. Okay, so we have about 35 people on the go at this stage. Hey, Sean, how are you? Yes, we definitely need to grab a coffee. Hello from Sydney. How are you? Please do allow StreamYard to show in your name so I can actually see your names. If I'm not calling out your name, I can't potentially see it. Okay. Awesome. Let's get right into this. So we are talking about how to generate higher cash flows from existing properties. And what does today's webinar basically involve? Okay, so what we are talking about today is potentially 5 key questions. Okay, so the first key question is setting up the differences between cash flow and growth. People are quite confused between the two, so we will definitely talk about that. And most important question, is cash flow more important than growth? I see a lot of people talk about inflation-proof properties and cash flow and pushing cash flow through, especially with the macro environment that we are in today. Is cash flow more important than growth? That is, $1 million question. What we are also going to look for is the risk and returns for various different strategies, and what do you need to choose at what various different times. What we are also going to answer in today's webinar is how to efficiently use the available cash to generate more equity via renovations or development. Okay. We are on step 4. We are going to also talk about conversions and what does that really mean, or generating high cash flow through property using 3 key strategies. And we are going to go into a bit of detail about what these strategies are. How do you go about doing these strategies? We are going to look at a lot of numbers as well in this session today. And the last question, which is the most important question of all time, is how to navigate through these high interest rate environments. Okay, my expectation is that the interest rate would keep continuing to rise. It would potentially go, the cash rate would up to 3.2% is what my expectation is. But if I use hindsight as a beautiful thing, what did I do between 2008 and 2012 when interest rates were 8%? I'm talking about bank rates, the investment loan rates at 8%. And how did I navigate through some of those times? So for those who are just joining in, who have never listened to me before, just very quickly, I am the managing director for Investor Partner Group. Investor Partner Group does a lot of things. We are a property investment firm. We do property advisory, buyer's agency. We also provide property development, tax, SMSF support, business structure support. My background is data. I've done data for pretty much all my life. So I bring in data basically back into property. Again, the core business is property development. So naturally, what we try to do is help client understand how to drive your personal portfolios and how to scale it up or transition into a much more development side of things, or create a business out of it. Okay. I'm going to jump on, and so bear with me if I'm jumping in slides, because there is a bit of material to go through. So as As a context setter, what I wanted to do is, very quickly talk about strategies and what strategies do people basically use in creation of their own personal strategy. And of course, a lot of people follow buy and hold strategies, but what does that really mean? How do you transition from a first-time investor to a much more high net worth investor? So buy and hold strategies definitely work. And they work for a certain amount of time, because what you're doing is you're identifying suburbs, you're identifying high yielding properties and high growth suburbs, you're catching that growth, and you're rinsing and repeating. There's times where you would hit the serviceability trap or you would hit the serviceability cap. So how do you go about, taking that next step? And that's where, the next transition comes into place, where you acquire development potential properties and use those multiple exit strategies or multiple exit properties to basically, push your portfolio on steroids. Naturally, what you're doing is you are creating and manufacturing your own equity. So you're going for land grabs, you're going for properties that are as close to the land value as possible. Okay, and ultimately, when you're doing that, you are manufacturing your own equity, but you're not remaining at the mercy of the market to deliver the growth that you are always expecting to deliver to you. The further transition from there is the worthy cycle, where you are talking about high yield. So you're talking about yield and returns, and you're not talking so much about growth. And these naturally entail co-living spaces, rooming houses, being money partner in bigger deals, full-scale development strategies. Talking about commercial, you talk about various different complex strategies in place when you're talking about high net worth space or as a sophisticated investor. So I just wanted to set the scene up before we jump into our first question, which is, what is the difference between cash flow and growth? And is cash flow more important than growth? Now, cash flow has two sides to it. So there is yields and there is returns, and people tend to not differentiate it properly between the yield and the return. The yield of the property is naturally the rent that you're going to get out of the property. But cash flow is also consistent returns that you make in the property, whether it be through renovations, flips, developments, manufactured equity conversations. People call it equity growth, manufactured equity. But naturally, you can create a cash flow out of that instance as well. Growth, in its truest sense, is the increase in the price of the property based on someone's propensity to pay a higher price. It is definitely driven by demand. And ultimately, it's someone's willingness to pay. So what you're waiting, it's a waiting game. So when you're talking about growth, you're talking about market's mercy to deliver that to you. Is it bad? No. It's good if it's done properly, if you use the data accurately to your own advantage. You're not looking at a point in time data, you're looking at trends going back 5 years, 10 years, and you're translating that data into basic actionable items or actionable insights. Understanding that the data is a science, and you need to understand that core. You need to have that granular understanding of the data before you can make those honest opinions. Okay, I see a lot of people, talk about some of these things that you can become a data scientist in 3 months or 3 days or 1 month. Ultimately, understanding the market and the growth cycles when you're looking at 10 years trajectory is a hard science. Okay, so be sure that you have access to that level of granularity when you are trying to understand the growth. Now, you're going sidetracked. So coming back to the original question, is cash flow more important than growth? The answer depends on where you are on the property journey. Okay, so cash flow as a yield is very, very important as a first-time investor. Okay, it provides you with shelter to absorb shocks. But having a multi-exit strategy property in your portfolio is even more important, because it is key to building a sustainable property portfolio. As a first-time investor, you naturally have no choice. Okay, you have to get your foundations right. So you have to catch the growth. You would potentially buy 1 or 2 properties in the right location, and once you've caught that early growth, you can naturally transition yourself into a much more experienced stage. Now, what does that really mean? It basically means that you're not betting on the market anymore. Instead, you're using your own returns that you've generated through growth, which was previously betting on the market, and you're generating better cash flows in returns for improved yields, creating manufactured equity, doing renovation flips, etc. And we'll talk about this in a lot more detail as we move on to the next slide. Now, as a first-time investor transitioning into an experienced investor stage, what you're foregoing yield in order to introduce returns. You're not foregoing growth, because growth would definitely be there. Okay, naturally, people think that it's one or the other, right? People think yield versus growth. It's not that. It's and growth. So you can definitely get both, but what you do sacrifice when you're transitioning from a first-time investor to an experienced investor, you basically sacrifice yield to add more returns to your portfolio so that you can grow your portfolio faster, okay, and manufacture equity. As a much more experienced investor, or a high net investor, or a sophisticated investor, ultimately what matters is cash on cash returns, okay? That's what it comes down to at the end of the day, right? What is $1 that you're investing giving you back every year without gambling, and without knowing whether you're winning or not winning next year, okay? So it's much more, it's the consistency of that return is what a sophisticated investor cares about. So is cash flow more important than growth? At the start of the journey, yes, but as you move along, you can sacrifice that yield to add more returns, which is a different type of cash flow, okay? So if I hope that I can communicate that message properly. If you do have any questions, please feel free to jump it into the comments, and we can have more discussions about some of these topics as well, okay? So the next slide. So the next slide, what we are talking about is this concept of Johari window, okay? So this concept of Johari window is all about, what are the low risk strategies, what are the high risk strategies, and where do you get the high returns and where do you get the low returns, okay? So it's a quick and nifty table where it talks about various different products or various different strategies that is available out in the market that you can use to put your portfolio on steroids. And every strategy that you're going to use, you're going to basically either go for a low risk or you're taking a high risk, and naturally the returns align to that. Now you can manage your risks, of course. It's not that just because it's high risk you don't do it. It's just that how do you manage those risk expectations and how do you mitigate those risks is quite the key, and we'll go down level of detail about each and everything. Now, of course, there is a lot more products out there in the market, okay? And the reason that we are not showing some of these products, for example, NDIS properties, duplexes, dual key, etc., house and land packages, we're not showing some of those, is potentially I don't classify them as investment grade properties, so I'm keeping them outside of this mix. What we're talking about here is investment grade properties, okay? So let's look at low risk and low return, because this is where majority of the times, I would say 90% of the investors play, okay? So these are normal houses, 4-bedroom, 2-bathroom, acquisition price between, I would say, $300,000 to $500,000. You are, aiming for a yield of between 4% to 6%. You may get 7 or 8% in an odd market somewhere here or there, depending on if it's a renters concentrated market. You're looking at lease terms of 12 months or more, LVRs of 80% or more. You can go 90% as well. And you don't really require any extra cash. And this is a buy and hold game, right? So this is where you're waiting at the market's mercy to deliver growth to you, okay? What you can do together with low risk, low return strategies is you can improve yields on some of these properties. And how can you do it? So you can add a granny at the back. And of course, adding a granny at the back requires a bit of additional capital. You're talking about somewhere between $100,000 to $150,000 to add a granny flat, depending on the size. And you can generate an extra $200 to $300 per week income, which means that your yield from the granny flat, it's somewhere around 10%. So what you're doing is you're normalizing or effectively, increasing the overall yield. So if a property is say 4%, you're increasing it to 5.5%. Okay. Now, the issues with granny flats, of course, people should know about this is, if you're trying to do it in your own principal place of residence, there are CGT complications. Of course, grannies are not allowed in every state. So a lot of people try it in Western Australia. Victoria doesn't allow it. South Australia doesn't allow it. People still do build it, but it's a lot of gray areas to how to use these granny flats, and you have to be a direct relative to rent these out or build these in the back. So that's the low risk and low return strategies where majority of the investors play. Okay, let's talk about low risk and high return strategies. Okay, so low risk and high return strategies is using a normal house and then converting it to something different. Okay, so you would hear a lot of people talking about conversions these days. Okay, so what you're doing is you are taking a normal 4-bedroom 2-bathroom house and you're converting into a one fully bedroom fully enclosed house, or fully enclosed unit, and you have a 3-bedroom 1-bathroom on the side, or 3-bedroom 2-bathroom on the side. And what you're doing is you're renting both of them out separately. Again, certain states allow it, certain states don't allow it. You can improve your yields from like 4%, 5%, 6% all the way up to 9 to 10% as well. These rooms can have short-term tenants or long-term tenants. You can have 6 months leases to 12 months or more leases. The LVR is relatively similar, so you're not changing the LVR, but what you're doing is you're injecting cash into that profit. So you're using into that property. So you're using an extra $30,000 to $60,000 to convert that normal house into a conversion house, or people call it co-living space or a rooming house. Okay, of course there is DA requirements and regulations and compliance, and we're not talking about that, but that is the gist of it. You're improving the yield so that it makes it easier for you to hold that property. Okay. Another one of the low risk, high return strategies is pack of units. So pack of units are great. If you can buy it in a high growth area, they generate some decent yields between 7% to 9%. Again, you can rent them at between 6 months to 9 months sort of time. The LVRs, vary in these products. Sometimes they do fall within the commercial bounds as well. So you're looking at, 70% LVR as well, and you don't require any extra cash in order to acquire these pack of units. Okay, the important thing, or the best thing about these pack of units is there is no extra land tax implications. Of course the valuation is there, but not each and every house or each and every unit is looked at it separately. There's no multiple council fees or council rates together that comes to with it as well. So there's definitely some pros there too. Okay, so those are the two low risk, low return, low risk, high return strategies, and we'll talk about some of these in a lot more detail as we go through the slide pack. Okay, let's look at high risk and low return strategies. Okay, now one of the things that I've called out here, and I think this would be contentious, because as soon as I talk about Airbnb or short-term rental, people would think, oh, well, it's high risk, but it's not really low return, it's high return. So the reason I'm calling it a low return is because of the amount of risk that you're taking and the amount of volatility that brings in some of these products. Okay, so again, the time frame that you're looking at from a lease perspective is days, nights, weeks, weekends, maybe month, possibly. But these are the type of properties that the banks don't like, okay, because of the short-term lease component attached to it. Okay, so they attract really, really low LVRs, even if you find a lender. But the worst case scenario is you have to wait for at least 1 year to prove that the income is consistent before a borrower or a lender would look at it. Okay, now in environments like now or today, high vacancies, low occupancies, of course, people are saving more money because of inflation going up. People are a bit scared, so they're not going on lavish holidays. They're not booking as much as what they used to. So, depending on the cash outlay that you're putting out there, is it a great long-term strategy? Maybe not so much, because you might do an Airbnb in areas where you're foregoing growth. Okay, so it's an important strategy to understand. I've seen people using this strategy in a very successful manner as well. People use apartments as Airbnb. They've converted houses or moved houses to Airbnb. I have some of my great friends who do this strategy quite successfully as well. But you have to have a portfolio to manage your risk when you're talking about Airbnb properties. Okay, and last but not the least, so you're talking about high risk and high return properties or strategies. You're talking about 3 key strategies here. Okay, so you're talking about full-scale co-living spaces or rooming houses. You're talking about yields between 9% all the way up to 15% yield, again on the gross basis. You're talking about lease terms between, months to 3 months, 6 months, 12 months. And you're talking about LVRs of 70 to 80%. We have achieved 90% LVRs in some scenarios as well. Net cash returns in some of these properties could be somewhere between $50,000 to $80,000, $90,000, depending on how much LVR are you sitting on. Okay. The other way to think about cash flow is small scale developments. So again, the acquisition is between 550 to 1.4. We're talking about small scale developments that you can, turn around and do it quickly every year. Again, you're looking at a time frame of between 15 to 24 months. And you have to catch that cycle of, doing one small scale development every year. I've seen developments being done in 6 months, 8 months, 12 months. I've just recently done a 6 months development as well. The product is basically ready to be flipped. So there are various different strategies there, and we'll look at some of those strategies too. The total cash outlay required could be very different. It could be from $200,000 all the way up to $800,000, depending on where you are taking an exit in a small scale development. Are you going all the way to build, or are you just flipping it? Are you doing plans and permits? Are you selling as house and land packages, etc.? So there are various different exit points when you're looking at small scale developments. And the last one is the renovations. So renovations is, again, a cool little nifty technique where you renovate, improve the capital or the equity within the property. And you can basically do that time and time again. Again, the LVRs are quite low at 80%. You need, between 15% to 200%, depending on how premium is the renovation, or how easy or quick is the renovation. That cash outlay would be, defined by that. And, you can make returns between 100, 200 to, $300,000, depending on how big or small the renovation is. Okay. I'm going to take a pause and see if there are any comments that are coming in here at this stage. I know I'm going in way too fast right now. So if you do have any comments, do feel free to, pause and, ask any questions. I can see a lot of hellos from all over the place, from Melbourne, from Sydney. Hi, Amit. Thank you for joining in. What are the expectations from the market in 1 to 2 years? We'll talk about that as well. Thank you for asking that question. And so next slide. So here we are talking about how to efficiently use available cash to generate more equity via renovations and developments. Okay. What I have here is a real case scenario. This is not a made up scenario. This is very, very real. Okay. So this is a property that we have acquired for at $750,000, rented at $800 per week. Block size of about 730, 740 square, presently yielding at about 5.6%. So very real, recently acquired, just recently settled, or it's not even settled yet. It's about to settle. Okay. So this is a truest example of property with multiple exit strategies. And most importantly, when it comes to times like these where you are, the macro environment is shifting, there is a lot of volatility within the equities market, the property market. There is high inflation, the demand is dropping, the prices are coming off, the market is cooling down a bit in certain areas. There still continues to go in other areas. What does this multiple exit strategy basically do? Or how do you engage with this multiple exit strategy? So let's use this example to understand that. Okay. So this acquisition is $750,000, has 3 exit strategies. Okay. The first one is converting it. So, okay, let me take a step back and explain this a bit more. So this is 2 properties. So one is a 2-bedroom and one is a 3-bedroom apartment, basically, or not apartment, but, sort of duplexes connected to each other. Okay. And so they're both rented out separately at this stage, and the property is not subdivided. It sits on a single title right now. So if you talk about the exit strategy for commercial, you look at the acquisition, you look at the stamps, you look at how much it would cost to renovate, and you're looking at, somewhere around $100,000 to $150,000 to convert it into a commercial property. Now we are talking about commercial property as this is doctors' rooming houses. Okay. So, rooms for doctors to use for consultancy. Okay. You can improve the GRV or the valuation for that property to up to 1.3 to 1.4 million, and grab an equity return of somewhere around $400,000 to $500,000, depending on where the valuation sits. And the reason being the valuation goes up quite significantly is because of the yields that you're creating out of this property. Okay, so that's what you're doing as exit strategy number 1 for this property. Okay, what is exit strategy number 2? The exit strategy number 2 is to develop the whole property. So, on the right hand side, it shows that, you can subdivide this into 2 lots, which would be the optimum use of the site. It's more than 21 square meter frontage. You can potentially do 3, but 2 would be a much more optimum solution. You're looking at, again, acquisition, you're looking at stamps, you're looking at development cost here, of about $900,000 for 2 properties. Okay, all up, included pretty much everything. Okay, you're not building double story, building single story houses. You're looking at GRV of about 2.2x, taking GST out and everything, because this is one of the prime pockets. This is only 8 to 10 kilometers away from CBD. This is Adelaide property. So again, we are looking at an equity grab of around $500,000 from this strategy if you go down that route. Okay, the third strategy, which is the easiest, most quickest strategy that you can basically engage into, is doing a renovation. Okay, so if you want to push the yields up, from 5.6% to say 7%. Okay, so what you would do is you would go in there and you would renovate the property. You would uplift the property to charge more rent. You would use probably about $80,000 to uplift both of these properties. Upgrade kitchen, better flooring, a new paint job, etc. And what you can basically do is you can subdivide this and sell them individually. Okay, you can potentially do that, or you can revalue the property after subdivision and pull out about $150,000 to $200,000 from the property. Okay, so again, properties with multiple exit strategies are quite key when it comes to environments like this. And right now, this property sits at comfortably 5.6% yield, which would keep it as positive cash flow if the rates are still sitting at around 4%, or it would take it to a neutrally geared property in the next sort of 2 to 3 months, but it's not a negatively geared property. Okay, let's talk about the conversions now. Okay, so this is question number 3. Or if you go back to the original webinar, what we were asking is, how do we convert a normal house to a high cash generating asset? Now, this is one of the first strategies that you can use to generate high cash flow. And again, the 3 strategies are depending on how much cash is available to you, how much equity do you have available with yourself. This is what it's going to basically decide and describe. Okay, so what we are doing is going to zoom in so that you can see it a lot better. I'm showing you a bit of the numbers first, and I'm showing you the floor plan. So this is a 4-bedroom. This is a typically 4-bedroom, 2-bathroom house. Okay, so and what you have done is you've carved off a living from a master bedroom, and you have created almost like a self-contained unit out of this property. And then you have 3 rooms at the back. You have laundry, shower, bath, family room, kitchen. And so you're not making any changes here. You might be doing some cosmetic renovation here, maybe paint job, etc. But you have 2 access points. You have 1 access point and you have 2 access points here, and you can rent out both of these places separately. So if you look at some of these numbers here, a normal property would be sitting at around 6% yield. By making a conversion and creating 2 income streams out of this property, you're pushing the yield up by 8% or to 8%, by an extra 2% yield. Okay, how much money do you require? Well, all you're doing is, for this house, is putting a wall here, a new wardrobe here, a walk-in robe here, a wall here, and just some cosmetic renovation, the cost to DA, cost to permit, etc. So not a lot of money required to basically convert this. You can see that renovation cost here. And then potentially what you're doing is you're using that cash amount to uplift not only the manufactured equity component, but also generating better yield for yourself. Okay, and this is a prime example. A lot of people are doing this in Western Australia. It's a very easy strategy to follow. And I do counsel a lot of people to basically go down this route and take this opportunity to explore some of this strategy. Okay, let's look at strategy number 2. So strategy number 2, you're talking about full scale rooming houses. You're talking about high returns here. You're talking about high risks as well, of course, with occupancies, and that's what it's called out here. I'm going to zoom in again on the plan so that you can see that this is the entry point. You're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9 bedrooms all in, and basically you're renting out each of these bedrooms separately. Okay, and if you look at the feasibility for this, This is the net return. You can see the occupancies at the top. I would say this is the best case scenario. This is an optimal scenario that would usually happen. Um, uh, and I know that, you know, a lot of our clients are sitting close to 100% right now, but we are assuming for the sake of this conversation that, you know, the occupancy would sit around, say, 90%. Okay, and this is the worst case scenario that was during COVID. So if you look at some of these numbers, you're looking at an acquisition of 953 inclusive of everything. So you're looking at furniture park, you're looking at construction cost, you're looking at pretty much everything else. Of course, you're aiming these in areas where the land prices are quite low. You have a finance at 80%, which is quite normal. We have been able to find a lender that is accepting a 9-bedroom house for a lot of our clients right now. We've assumed the higher interest rate at 5%. You know, even if you push it to 6%, that should be okay. You know, it wouldn't impact the numbers quite aggressively. And so even after taking everything into account, you're looking at a net cash flow of about, you know, $56,000. You're looking at a massive depreciation benefit. So if you look at post-tax percentage returns, it sits significantly higher. You're making an extra $53,000 net of tax on this. And pre-tax of about, you know, 56, and net tax of about $53,000, or should I say 50 to 49? Okay, so again, you know, you're yielding around 15% in the best case scenario. In an optimum scenario, around 13%. The net yield post borrowing still sits at about 5.3%, way better than, you know, some of the commercial property yields that you would get after borrowing. A lot of people, when they talk about net yields in commercial properties, they don't really talk about you know, the borrowing cost, you know, which is significantly higher versus the residential rate that you're getting here. Okay, so again, this is a real scenario. This is not a made-up scenario. You know, we have acquired these products. I've acquired this product myself as well, or I'm in the process of, you know, building one. So that's happening in the background right now. Okay, so some of the amazing returns that you can definitely see at a very decent price point too. Okay, number third. So here we are talking about using your existing property and converting into an Airbnb scenario. Okay, so again, very low equity requirements. You probably need a furniture pack to, you know, establish the house and set it up with furniture, etc. But you can use your existing house and reconvert it into an Airbnb. So the most important thing for this is, of course, location. You know, like any other thing with Airbnb, major city locations, touristy, business travelers, you know, that's the attraction point when it comes to Airbnb. You need to understand that there is cash outlay of, you know, setting it up and putting furniture in. You might be required to do some sort of refurbishment, you know, so, you know, a new paint job, upgrading the kitchen, upgrading the bathroom, etc., you know, putting in TVs, etc. All of that is quite important too. Okay, the two most important things when it comes to Airbnb is projecting the occupancy and the room rate, as to what to charge and how often do you think that this would be filled. Okay, so it can be quite a difficult task projecting occupancy, but what you can do is you know, you can go to Airbnb and you would notice that with each listing in Airbnb, and this is public information, that there is a calendar which naturally shows that how many times that they are booked, how many nights that they are booked, and how many nights are available. So quite a nifty tool and quite a nifty technique to basically use to understand what projected occupancies are. So if you're looking at a particular suburb or a particular street, I would suggest going to Airbnb, finding some of the local properties there that are on Airbnb, and understand what the projected occupancies are in those areas. Okay, operating cost would be the next step, having an estimation of, you know, what an operating cost would be. And I've made some assumptions. I'll go through the cash flow with you as well, as to see as to what operating cost can you expect. Okay, there are groups available, there are Facebook pages available for Airbnb people, which basically help you understand, you know, what operating cost to expect, you know, out of a 3-bedroom versus 4-bedroom versus 5-bedroom properties. Okay, and the last one is the room rate. So what to charge, and a lot of people, you know, completely miss out on a lot of these things. So again, you know, Airbnb is the best tool when it comes to understanding what the room rates are. So if you go back to the listing, you would see that each of the listing gives you the daily rates, weekly rates, and monthly rates. You can go on the calendar, check out the available dates and what they are charging in those particular locations. Okay, it's very, very important. And I just wanted to very quickly share a story here, where I know a friend of mine basically got the room rate wrong, identified a wrong person or attracted the wrong crowd into Airbnb, and they completely destroyed their property. Okay, so it can get really, really messy. There are risks attached to it, of course, and you need to understand some of these dynamics attached to some of these things. What does that mean in relation to the acquisition? So acquisition price for some of these properties, I would say, sits between around 400. This assumption is done on $450,000, but you can go crazy and acquire property, $700,000-$800,000. I've seen some of these properties in Nusa Heads, for example, where you can acquire a really expensive property and put it on Airbnb, and you make some decent returns out of it. Again, an 80% LVR, you're looking at about $12,000 to $15,000 in furnishing the house. Assume the higher interest rate. You're looking at a gross yield of about 13%, and you're looking at a payback period of roughly about 10 years. Okay, so again, all of this information is available. So if you want to get hands on this model, please reach out to me. I'm happy to share all of these numbers with you, and I'm happy to share this model with you as to how to navigate through the projected cash flows. What are the loan drawdowns? How do you track and monitor some of these things on an ongoing basis? Okay, let's jump on to the cash flow side of things when it comes to Airbnb. Okay, so this is a detailed cash flow of a real Airbnb property, and what you're doing here is you are basically estimating what sort of returns are you going to get every year. And I've made some assumptions around, what is the room occupancy looking like? And this can change quite drastically. And it would be great to monitor and track some of these things. How often is it updated, or how often are the rooms available? And what are you charging per room? What is a daily rate? What is a weekend rate? What is a weekly rate? What is a monthly rate? So this $270 or $78 is an effective rate, and every year, of course, the inflation applies to it. So we are growing this rate by inflation. And so what you are coming up with the total revenue, which is the gross revenue, and then you are allowing for 13% of cleaning, 11% of supplies, utility, and reserve for maintenance. So you're allowing about 36 to 40%, of the cost of the total gross towards expenses. Now, this again, does not include borrowing costs, so you need to allow for the borrowing cost in there to come up to a better net result or a better net yield. And if you go back here, you can see that the borrowing has been allowed in these numbers versus the other numbers. Okay, so this is the interest payments and the repayments, the interest repayments. Okay, so I'm going to continue. So this was the third strategy of how to basically use that existing property and convert it to an Airbnb property if you have the right location placed in and put in. Again, does fall into that scenario of high risk, low return, not high risk, high return, because it depends on how well are you with managing some of these properties. What sort of occupancy are you getting? In a market like today, it can be really, really risky. So you need to do a lot of homework to ensure that you're mitigating your risks and keeping the returns high. Okay. Now, this is the interesting bit. And so this is the final question about, how to navigate interest rate environments, and what did I do in 2019, between 2019 to 2009 to 2012, when the interest rate was quite significantly higher. Okay. So again, for people who don't know me, our company has been operating for quite some time, and I've been, investing since I was quite young, not this old. So it's important to understand as to how are you navigating these interest rate environments in the past, and some of the learnings that you can take from that and apply to today's environments. Now, I'm not saying that the interest rate is going to go to 8%, touch wood. But I'm saying that the interest rate would go somewhere to around 5.5% to 6%. There is a likely chance, definitely, right? So there are 5 things naturally that you can do when it comes to higher interest rate times. Okay, so number 1 is, of course, generating more income. So kill the single income dependence, work harder, do overtime. If you're husband and wife, you're trying to change jobs and earn more income, or start a side business, a side hustle or something. So that's where generating income comes into place, to basically keep up with higher interest rates, higher inflation. What you can also do is, of course, reducing discretionary spend. And what discretionary spend basically means is that spend that you can control, like, going out and eating out, buying expensive clothes, going on expensive holidays, etc. So it's the spend that you can control. There are things that you can't control, for example, school fees or utility bills or insurances. Of course, you can, go out and scout out better rates or better insurance companies, but that spend is definitely there. So you can reduce the discretionary spend, that, of course. Now, these two strategies, what you're doing is they are impacting your lifestyle. So your property portfolio should be set up in such a way that it should not be impacting your lifestyle. The property portfolio should be able to absorb the shocks and the risks that are thrown at it. The third strategy, which is quite interesting and no one actually talks about it or thinks about, is an offset strategy. So um, you would see, every time interest rate rises, a lot of people go out and basically refinance their house and keep a lot of money in their bank account on the side. Okay. And so what they are planning about or thinking about is using that money to manage cash flows. Of course, it's not a bad thing. Okay. It's definitely the least favorable of all, but it is a good way to hold on to that asset and pass that cycle, whether it be 1 year, 2 year, 3 year cycle of high interest rates. Okay, so offset strategy is great for those who have caught some decent growth in their properties in the past. Not so great for those who haven't bought in the right suburbs, in the right pockets, and so they can't use that offset strategy. So one of the things that I always talk about is when the markets are going down, it's the impact of people feeling poor that basically drives the sentiment or the confidence of the market. It's not really that people are actually poor. It's not that, my house price has gone down, so I'm poor. It's that mental note of thinking about, okay, houses prices are going down, so I'm actually paper poor. Okay, so offset strategy plays a really important role in there, because you can pull that money out and put it in an offset account. Yes, it would impact the cash flow because you are getting access to higher debt. But if you have it in an offset account, you would be offsetting your interest rates. And what you're doing is you're forcing yourself to pay off something faster. Okay. If you're talking about investment properties, there are no impacts, because keeping that money in an offset account and not using it is basically offsetting some of the interest rate rise impacts. Okay, so it stops any interest rate rises from that additional amount that you have sitting in the offset. Okay, now there are two more things that you can do when it comes to higher interest rate times. Okay, and a lot of people don't talk about it, again, don't think about it, but these two things, what tends to happen is that the faster the rate goes up, there is less likely chance that you would make these choices. So the two choices are, number one is to invest more, to make more, to get more higher yielding properties, whether it be conversions, whether it be rooming houses, etc., to offset that impact. Of course, as I said, as the interest rates goes higher, you are less likely to make that call, because one, your serviceability is going down as the interest rates are going up, but two, your confidence keeps going down in relation to you going back into the market. Of course, experienced investors would always do that. They would find ways and mechanisms to create more yield in existing properties, or acquire more to add more cash flow to their property portfolio. The second one is the renovation and the development strategies. Of course, people shy away from making big decisions around development or renovations, but they are great ways to add more cash flow into your own portfolio. You're talking about renovation, all you're doing is you're buying a house which is a rundown house, and you're basically using that as an opportunity to manufacture equity, revalue, and then use offset strategy to hold those properties again. You can have these properties as high yielding properties too. Okay, so what did I do? So I have two scenarios to discuss, and I'm going to talk about both of these scenarios, and I have some of these pictures from 2011-12 to showcase as to what does that mean from a renovation perspective. But when you talk about 2009 and 2010, I was pretty much capped out by interest rate rise. Okay, my capacity to acquire more disappeared. I was in a position to not make that decision, like any other person. So of course, the more I pushed myself, in not acquiring any better properties or going down the renovation route, of course, what I did was I followed the offset strategy. I started working off 2 jobs, generate more income, so that I can hold on to these properties for as long as I can. Creating multiple income basically meant for myself, doing 2 jobs or 3 jobs at that time. Okay. And reducing the discretionary spend like crazy at that time. Okay. Ensuring that, I can hold on to these assets for as long as I can. Of course, that's, what I did. Of course, I was sacrificing my lifestyle. But what I was doing was I was actually saving money on the side at that time as well at the same time, so that I could make better choices, better decisions in 1.5 to 2 years time frame. So what happened in 2020, 2011, basically. So again, it was quite different. So I started acquiring properties to manufacture equity. I take that leap of faith and said, okay, let me find these properties where I can do small scale developments, to manufacture equity and use that as an opportunity to break the serviceability trap, and put my journey on steroids. Okay. I got the money out for renovations. I used that as an opportunity to increase the manufactured equity component, refinance, and then do it again. Okay, I'll very quickly talk about 2 examples that are there. So pictures on the left and the pictures on the right. So one of the acquisitions at 420, total acquisition cost was around 440, including stamps 445, including stamps, renovations around 15 to 20K. You're looking at an upfront money of about 10% LVR, paid a bit of LMI on it, had a debt of about 378K. You do that renovation, you go back to the bank. These properties were valued at about $535,000, 10% no LMI. Your debt goes up by 481 instead of 378 because of a higher valuation. You refinance that money out, so your money is out, and then basically you can go back in and do something else. Okay, these properties were sitting at comfortable 5.5-6% yield, so I wasn't so much worried about the cash flow side of things. Okay. Again, another example was 490K acquisition. Again, plans and permits approved. We ended up flipping the side. 80K spent on plans and permits. Flipping the side meant that we are looking at we looked at selling that at about $780,000. Made about roughly about $200,000 on pretty much all of this. So I wanted to share my own experiences and an example so that people can relate to it in a bit more realistic sense as to what are the strategies or what are the cases that you can definitely follow. And as you see interest rate rise between where we are in October to say November, December, January, February, March, April, you would see that the pain gets harder and harder. So the quicker you make a decision, the better your next 6 to 8 months would be. Now, having said that, I was talking to someone this morning and I said to them that my expectation is that 2.5% to 3% cash rate would be a new normal. This is nothing out of ordinary. Maybe we're talking about 1.5 to 2%, cash rate, but we're not going down the route of, 0.1% cash rate. And if people think that we are going back to that rate, we are quite sort of living in a limbo or living in a hypothetical or a fantasy land. This is a new normal and they are creating a normalized world for us. So, if your interest rates are sitting at 3.5 to 4%, this is where, majority of the normalization looks like. This is where they're trying to bring us to equilibrium when we talk from a long-term perspective. Now, I'm going to open the floor for questions. So thank you for listening to me. Let me change my view so that I can see as to what questions are there. And then we will basically start looking into some of what people are talking about. Okay, so we have Asen Wakar talking from Craigieburn. We have Sean, no risk, no reward, 100%, my friend. That's what it is. What are the future expectations from the market in 1 to 2 years? Look, I've made that quite vocal, Amit. What are the future expectations from the market? My future expectations from the market is that the market would start coming back. I would say as soon as the interest rate starts dropping, my expectation is somewhere around July, August, September next year. People would realize, as soon as people realize that this is the new bottom, people would start coming back into the market. I talked to a lot of people who are investors, and I always tend to find that a lot of people are sitting on the fence line with the rate or with an approval of say $500,000 or $600,000. And I always say to them, why are you sitting on the fence line? This $500,000 approval that you have on hand right now would turn into a $300,000 approval by next year, okay, or $400,000 approval by next year, which basically means that your opportunity to acquire a better asset drops significantly. Your opportunity to go in and get something which is a worthy investment property drops quite significantly. Another impact that we are seeing in right now, and we've always seen it in the low markets, is that as the interest rate rises, there are less motivated vendors who wants to sell properties. Okay, so a lot of investment grade properties do not even hit the market, and that's why we're dealing with a lot of direct to vendor channel right now. We're going directly to vendor. We are working with off market opportunities right now. So it's important to understand some of these mechanisms and not just think about, oh, I'm going to enter into the market when it hits the bottom. You would only find out when the property market is hitting the bottom when the media is talking about it. And if the media is talking about it, you're already late to the party. So understanding these key circumstances is quite important. I'm going to scroll up and see if there are any more questions. Nothing for me at this stage. Look, thank you for joining in. And look, people who are listening to this session later in the piece, it would be great to drop it into the comments, any questions, or reach out to me directly, or Sheena or Hani, and they should be able to assist you in getting my answers to you or setting up a time for us having that one-on-one discussion. What do you think that the market is heading in the next 6 months? A Facebook user is asking. So very similar to what Amit's question was, where do I see that the market is heading in the next 6 months? Okay. Western Australia, let's talk about suburb to suburb. Okay. So Western Australia is still going in strong in certain pockets. It's not stopping. It's not going cold. While the rents are high and the demand is high, the property market would continue to go up. I know some of the properties that we acquired earlier in the year around, sub threes, early four mark, they are well in their 500s right now. And this is 6 months while interest rates have been rising. Adelaide. So South Australia, still, again, there are pockets of Adelaide that are still doing quite significantly well. Of course, a lot of the premium pockets, where you talk about the west of Adelaide or the east of Adelaide or inner east of Adelaide, has taken a lot of toll. But southeast is doing really well. Northeast is still doing quite well. There are pockets where we are going back in there where we never were going back in because we thought that the market in those suburbs were saturated. So those pockets are opening up again. We acquired a property just recently where the suburb median was well over $575,000 and $80,000, and we acquired a property for $505,000 for a client. So again, a 3-unit site, by the way. Where would I learn more about how to convert houses? Look, definitely reach out. I'm happy to provide as much support and advice. You need to have a great team where we are talking about conversions. You can't do conversions while you're sitting far away. You need to have a local team in place, a good tradies. You need to have an architect. You need to have carpet layers, tilers, etc., plumbers, electricians. So you need to have a good team in place for you to work out the conversions as to how they are going to work. There are service providers who do provide that service. We do assist our clients in acquiring conversion homes or in setting up conversion homes as well. Again, various different strategies. When you are looking at a strategy as a whole, or property strategy as a whole, it is an important strategy to not miss out on. Okay. Thank you very much. Look, it was lovely to talk to you. Okay. And again, if you have any more questions, feel free to drop it into the comments below. Thank you for listening to me again. Have a wonderful day. Have a wonderful week. And stay safe. Take care.